Hello everyone. In this video I want to show you how to enter the rolling of a trade in the all-in trading options journal. Rolling is the act of closing one position and opening a new one. The idea of rolling a combined strategy, such as a strangle for example, is to do it in one combined order to the market and execute it at a single net price. There are a number of reasons you might choose to roll an option position, but typically the goal is to extend duration or the days till expiration, to give the position more time to become profitable. So let me illustrate in the journal. Imagine Don decides to roll his PayPal position. The PayPal position is on this row, and he has a strangle position open, a 60 put 90 call strangle, expiring on the 15th of September and with the net credit received of $2.77. I can all read that in the journal, as you can see here on this row. Now if I look at the follow-up part of the journal, I see that the action recommended is to manage based on the number of days till expiration. As you can see in the user profile, and I will just go back for a second, in the user profile the parameter is set to make a color indication when the DTE is below 21. And that's exactly what the journal does. It gives here a color warning that the number of days till expiration, which is 17 here, is below 21. So the journal actually warns John to make or to manage his position. So John decides, because his position is not profitable yet, it's still below water, it's minus $27, he decides to roll the strangle out in time into the October expiration. When he enters a rolling trade in his broker's platform, he will at the same time buy back the September put and call and sell another put and call at the same strikes, but now in the October expiration. Let's say his broker's platform will mark that this trade will give him a credit of $1.12. Which is actually logic, because the price will have more time value in it, being in a later expiration. Okay, how does John now enter this trade into the journal? He does exactly the same. He closes the old position and opens a new one. So he will select in the closing parameters, in the correct row of course, he will select roll. And he enters the date that he was rolling. Let's say he did that today, the 29th of August. The spreadsheet will mark a number of fields as being closed, and in the trade results you will see that actually this position has been rolled. The other fields we do not have to fill them in because they're grayed out. That's a clear indication that they are not to be filled in. Now John has a possibility to write a note for himself in the notes column. So here I will write rolled strangle to 20th October 23 for a net credit of $1.12, resulting in a total credit received of $3.89. The second step is to open the new position we rolled into. So I will select the action. I am selling to open a strangle. The date of rolling is today, the 29th. And the initial date here remains the opening date of the initial strangle position, which was the 12th of July 2023. The trade is made for the same account, for the same trader, it's a sell to open, it's for the same option, and it's for the same ticker. So I can quickly copy these fields, copy and paste them here. This allows me to win some time. And now I complete the share price. Transaction price was $88, and the strategy that I mentioned is still a short strangle, 60 put 90 call. There is however a new expiration date, so I will select the correct one, 20th of October. The quantity is 1 strangle, and now important, so pay attention, the new premium of the position is the total net credit received. This means $3.89, and not just the amount of $1.12 which I received from the roll itself. No, we need to add up all the credits received or debits paid to arrive at the correct premium received for this open position. Only this way we will calculate the correct profitability. So I enter here $3.89 $2.89. Let me just scroll over a bit. And I complete the rest of the fields marked in red. For the trade fees, this transaction had 4 legs, so my fee will be 4 times the fee for an option trade. Let's say the broker charges $2 per trade, that makes in total 8. So I will type here in 8. And I complete furthermore the relevant data for the position that I can find in my broker's application. Implied volatility rank was 22. The SPY beta weighted delta 1.5. I have a probability of profit for this position of 66%, and the margin requirement was mentioned to be $1,800. The fields are calculated again, and next I complete the current parameters where I can always adjust later when I do the follow-up of the position. So now when I just open this new trade, the status is of course open. The current price is, let's say, $3.80. It has fluctuated a little bit, $3.80. The SPY beta weighted delta is the same, 1.5, and the margin requirement has also stayed the same, $1,800. The last step is to mark the status of the first position, because you can see here it's still marked in red, and we need to indicate it as a position being rolled. So when done, the row will go gray and I have rolled the position also in the journal. The dashboard parameters will adapt and update automatically, and the values in the result report will indeed also adapt automatically. You can, for example, see here now we have one option trade that has been rolled, and also here in the overview, currently open position, the new position of PayPal appears with a new expiration date, a new paid premium, and the current price to close is mentioned here. So I hope it's now clear for you how I enter my rolling into the journal of the spreadsheet. That's all for now. Thank you for watching, and I will see you in the next one.